One of our more provocative papers in the last year is one that challenges the basic principle of target date funds, what many people call glide path investing. Glide path investing starts investors early in their career with a very heavily equity-centric portfolio and then ramps down their aggressiveness as they progress through their careers, so that by the time they're getting ready for retirement, they have comparatively little in equities and a lot of money in bonds. This approach has been around for a very long time, and it really has two key goals. One of those goals is to maximize the wealth that an investor has upon retirement, and the second is to give them clarity as to how much income they'll be able to retire on, how much spending they'll be able to sustain when they retire. Unfortunately, glide path investing fails on both dimensions. It leaves investors with less wealth as they approach retirement than other strategies. Our simple test was, what happens if you do the opposite? If you start with a very conservative portfolio and finish with a very aggressive, equity-centric portfolio, you wind up richer. Even though your average equity investment over the course of your lifetime is the same, you're richer. Why is that? Because your dollar-weighted average is more equity-centric. When you have more money later in your career, you're more equity-centric. So in our study, what did we do? We took the notion of starting with 80% stocks, 20% bonds, when a person's 20 or in their early 20s, ramping down the equities to 20%, ramping up the bonds to 80% by the time people are in their early 60s and getting ready to retire. We compared that with a strategy where you do the opposite. You start at 80% bonds and you finish at 80% stocks. And we compared that with a static 50-50 mix throughout life. Well, what leads to the greatest wealth in retirement? The strategy that ends with 80% stocks, not the one that ends with 80% bonds. Which strategy has the greatest confidence that you're going to have good income in retirement? That is to say, which strategy has the best downside, the least bad worst outcome? The one where you finish aggressively focused on equities. Well, that's a shocker. And which strategy wound up giving you the tightest spread between best outcomes and worst outcomes when you're 10 years away from retirement? Surprisingly, it didn't make a whole lot of difference, but the more aggressive strategy was slightly the better on that dimension too. So the bottom line is that the more aggressive strategy, where you start conservative and become aggressive, actually dominates. The results of this study rattled a lot of cages. It's not our goal to recommend that people start conservative and end aggressive. That's not the point of this study. The point of this study is that the classic glide path is so easy to beat, and therefore that we owe it to our clients to rethink how we do this and to come up with better answers. It's not that the inverse glide path is the right answer. It's that the classic glide path is the wrong answer. Out of all of this work, we came up with an array of ways to make glide path investing better. Firstly, within the stocks and bonds, do we really want a capitalization weight? With cap weighting in stocks, the more expensive the stock is, the more weight it gets in the portfolio. That doesn't make sense. Within bonds, if you capitalization weight, the more a borrower wants to borrow, the more you have to lend them. That makes no sense at all. And so the notion of changing to what some people term smart beta strategies, strategies that weight on dimensions other than market capitalization, other than price, can be an important way to improve glide path. The notion that real sustainable spending matters more than the value of a portfolio, a real return orientation, makes more sense for glide path investing. That means putting more money into assets that can provide a real return even when inflation reignites. The notion that an asset mix that pushes us too early into a conservative allocation merely hurts us and creates an automatic buyer of bonds no matter how bad the yields. This hurts the end customer of a glide path strategy. What about a strategy that involves a more static mix that's more aggressive until rather later in one's career and then tapers off the aggressiveness within the asset classes, not between asset classes, by moving to low duration or low beta strategies within stocks? These wind up being some enhancements that we think make just a lot of sense within the glide path arena.